Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for November 1st, 2014. Market remains in bullish volatile conditions on an annual basis using weekly RSI 14. We are above average in the neutral area at 62 out of 100. On a 10-day basis using the 10-day NDX or short-term market condition, we are overbought with a score of 99 out of 100. Looking at the market mosaic, long-term trend, the price relative to the 200-day moving average is at 6.13%, which is up into the yellow bullish category. We have a 4% cushion to sideways markets where we briefly dipped in the last 2 weeks. The slope of the 50-day moving average has improved to yellow neutral at 0.11. ADX is also neutral at 20.5. ATR percentage remains volatile, although the volatility is declining at 1.48%. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is 1.0. Current reading is at 1.12, so we are in risk on conditions. If we take that score of 1.12, compare it to the last 5,000 trading days, and then find the average and standard deviation, we come up with the Z-score, or the risk Z of that indicator, that's at 1.38. This histogram shows a 90-day time series of that indicator, and you can see that in the last 90 days we've gone from a flat line to -2 standard deviations to +1.5 to a little over -2.5, and now we're up to 1.38. This turns out to be a useful indicator for intermediate term swing trades in the volatility ETFs. For instance, when this indicator ticked up, this was the beginning of a 40% move in symbol XIV, which went from a low of around 25 to 35 in a matter of about 8 days. And so we like this for helping us understand sharp turning points in the psychology of the market, which then correlates to subsequent equity follow-throughs. It can be tradable on its own. So we like this as a short-term barometer of market sentiment. Blended monthly rebalancing. These are the new positions held by ETF portfolios 13, 22, and 32, with the next reevaluation being due on or about 1 December. And these are the current leaders in the other portfolio sets as well. Continued strength in Nike, Home Depot, United Health, Visa, and Goldman Sachs. In ETF 2, the theoretical exposure is back up to 50%. The model portfolio remains at 50% exposed. A zoom in on the components of the ETF 13 and 32 portfolios. You can see we're about half and half. We're on a buy versus a cash position, which comes from price with respect to its 4-month moving average. Technology, real estate, and treasuries still in the lead. And that represents really some defensive plays, alternate asset choices, but then 1/3 in the strongest sector, the technology, which has been leading the way for the past 4 months. In the ETF Max, we're looking at the same lens at the top 50 or so symbols in the 1300 ETF database. The strength in biotech has been remarkable. The top 5 are in biotech, and that's been tradable on a short-term basis as well. This looks at the S&P 500 through the same lens. It includes the symbol that these individual companies are a member of in the sector spiders. Monster Beverage, Green Mountain, Vertex, Pharmaceuticals, and so forth. You see the predominance of XLV, the healthcare. This is the market health check. The vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets that have been acting as support and resistance. You see that we've moved from this lower red line all the way from at 182 all the way back up to retest previous swing highs at 202. Very symmetrical sell-off and then reversion. The red lines have been support levels that were once resistance and act as a price ladder should price fail from here, or as support levels should price begin to retrace and then find support. The dark blue shaded area in the middle is the river. That's the 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the floodplain. That's the 30-period Bollinger Band plus or minus 2. The pink shaded region here is the dragon. That is an accelerated Bollinger Band. It's 10-period with plus or minus 0.5. The red shaded area is the 200-period moving average, and the region underneath that is where we start getting into bearish territory. This black thin sine wave looking line is the slope value of the 30-period regression line, and that's been a marker for important turning points. Each of the blue circles is a place where either the market was at the slope of that value was at a local maximum, or where it crossed the zero line. Anytime it's below this dotted zero line, the slope of the 30-period regression line, which is the central black line, that's the 30-period. When it's underneath that dotted line, the slope is negative, and that's been bad for the market. But turning points, especially those that occur after the slope is below minus 0.22, have often been key turning points. And so that's where this one, only 2 days after making the local low, the alert was that things are starting to improve, meaning that the that the slope downwards has started to roll back up. It hasn't gotten positive yet. It takes a couple more days here before that's going to cross the zero line. But when the slope does cross the zero line, I want you to notice the follow-through that's been available in each case in the direction of the slope of that line. So this suggests that if we can get through and hold above 202 here, then we have room for another leg up, possibly as large as this move. And here it could be another 3 to 5% in the next surge. I want you to notice the percent price oscillator here, which signaled the end of the bearish swing just a couple days after that bottom was put in, and that's when the slope started to improve. And you notice we went from a Z of minus 3 to a Z of minus 2, and then minus 1, and now we're all the way up at a Z plus 2 on the far side of the floodplain. So that's a 5 sigma move in that rebound. This is the time period in which XIV also went from 25 to 35 at the same time that the market was rebounding from this adverse 3 sigma move to the downside. So that percent price oscillator turns out to be pretty useful. The market can stay overbought here in Williams percent R like it did last time. We've been in there for about 8 days. You can stay there a long time. You can stay there 20 days like it did this last one. And so we're ready for a continuation of this pattern to the upside. The 3 blue lines represent the RAF regression channel, with the central line being the regression line and the outer channel being formed by maximum excursion during the look-back period. The black line, very wide here, just shows the dimensions of that 30-period regression channel. Still sloping down, so that tells us there's still room for this to go now that it's gotten up to and is testing 202. So a couple scenarios here. Number one, it drifts into sideways chop like it did through here after a nice rebound from the last sell-off. Or we get a breakthrough and continuation above 200, then off we go. And then the same size of this move, a 3 to 5% would be the next leg up, would be not unusual behavior. Or in the same way that it cycles from extremes, we would see price fail here and then come back to the Bollinger Band mean back around 195. That would be well within statistical normality as well. In that case, we would be looking for evidence of finding support and then a continuation of this next leg up like a lazy W. So the bulls are being favored right here. ETF2 regional report is split at 50-50, with 5 of the regions on buy signals, 5 on sell signals, which is an improvement from the 20-80 split from last week. The S&P at 78, still better than the globals at 67 on the strength column. Inside the U.S., a slight shift in the order of strength. It's still tech and large caps in charge, but now small caps have made a nice little rally here and are now ahead of the mid caps, which is reversing about a 6-month trend. The 2 strongest sectors remain technology and large caps. The 2 weakest sectors remain Latin America and the globals. Inside the U.S. sector spiders, you can see the real power of the U.S. large caps in here. But with the defensive plays of healthcare, utilities, and staples balanced by the strength and are joined by the strength in the growth area, technology, and financials. So this is a reinforcement of the U.S. large cap strength. World market model. See, everything in the U.S. is now back above average, and with the technology exceptionally so. Japan has moved back above average. Asia less Japan below average. India remains the real key leader among the Asian countries, but strength in China, Hong Kong, Taiwan, Thailand, Philippines, and Vietnam. Inside Western Hemisphere, Latin American emerging markets below average, but Mexico doing fine. Brazil still suffering in the red. Everything Europe below average, and a number of countries exceptionally so. U.S. is leading its global business sector counterparts in every case, but there is strength in healthcare across the globe. The dollar up is still a very powerful position. ETF top 30, just as based on the ETF2 logic model. Biotech's clearly where it's at, along with healthcare, pharmaceuticals, followed by India. In the Dow 30, new strength coming in with Visa in the green and the white, and 3M also green and white, and Johnson & Johnson green and white, a good place to be. Also, DuPont is continuing to add. Coca-Cola is weakening. We saw that big gap down before. We've got a swing trade in it based on the exaggerated overreaction play, but it's showing some systematic weakness here with the white and green. White and yellow is the next order of the next cycle of symbols getting better. Not in the green status yet, but improving. American Express, Pfizer, and Boeing. At the bottom, still IBM, the only true laggard. The red and then yellow says that weakness is a recent phenomenon, and more pain following there. I like that General Electric and Caterpillar have moved out of the red and up into the white and yellow regions in here, so Caterpillar on the way back up. ETF liquidity, just for your reference, notice that the VIX still in intraday range percentages of 9.7%. Shifting to the daily report now for this is done as of Friday's close of business prices for Monday. EFA on a short signal, so if we see weakness in the market, I'm willing to go short using the overreaction strategy. You can see that volatility has peaked and rolled over. As that 2 sigma to the upside move rolled over, that coincided with a 40% move in XIV, just so you know. You can see that although ADX is low, it has now started to hook back up above 20, and now the bulls are back in charge, and that's the basis for believing in the strong possibility of a continuation pattern here if we can get above 202 and stay there. A good long run is now possible. Strength leaders have been Intel, Goldman, AT&T, Microsoft, and Morgan. The 10-day max pains, the one that are the largest percentage away from their 10-day high in the Dow. Coke, IBM, Boeing, Home Depot, and Walmart. I like that for Home Depot as an opportunity to get back on board a relative strength leader should it start to resume its strength. Only a handful of symbols on the auto framer, mostly the commodities, and those 2 that got smacked down the most in the Dow, Coke and IBM. VIX on a 551W, that turned in quite a performance too, so some natural profit taking in play. No signals in the Dow Tactical 30. With Coke and IBM are the only ones on auto framer better than 2-1. Just a triple screen here in Treasuries and 551Ws in VIX and the Ag. Some impressive looking auto framer numbers. Silver and gold ought to be on our list here. Opportunity to buy some longer term positions if we see some evidence of finding support. They were big percent losers over the last 1 day, 10 day, and 1 month, as you can see here. In the auto framer, again, these are your technical details here for the favorable reward to risk ratio trades on the basis of trade location, and then the regression line fractal frameworks. These in the top stack, the symbols that are the most numbers of average true range below their own fair value long term, which is we take to be the RL270. So these are the rebound candidates or the value plays, the extreme value plays. So it's not surprising to see IBM and Caterpillar. I really like the idea of Caterpillar. We saw in the ETF2 lens, it's starting to improve systemically, still well below, almost 2.5 ATR below its 270 regression line. We'll take a look at that in the for members in the webinar tomorrow. ETF 100s, those value plays: gold miners, silver, natural gas, and blended commodities. The ones in the bottom stacks are in the red down here are the ones that are the most above their own ATR, and these turn out to be the relative strength leaders because they are leaving the station, and short term is accelerating away from long-term value. So that's Nike, Home Depot, Travelers, Procter & Gamble, and Goldman. In the ETF 100, you can see it's the biotechs here in IBB and XIB. That's where the strength is coming from. XLV, pretty interesting there too, accelerating in that healthcare area. That's one a longer term play we might be very interested in as well. All right, that's everything I want to cover from the weekend report and highlights from the daily. More charts of interest coming tomorrow and posted in the chat room for members. Keep your risk measured and your powder dry, and be on the lookout for some news about a blended monthly rebalancing collaborative tournament that we're going to sponsor to continue to develop new ideas for portfolios and backtest your favorite ideas and see how they work on different time frames. So more to follow there in the newsletter. Take good care. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.